Welcome back, everyone. This week, we're going to take a visit over to my investor newsletter and market insight page, and I'm going to read you a short piece about the Hacienda Hedge. You might recognize it better as Mexico's oil hedge. Around this time of the year, people talk about it a lot, so I thought I would shine some light on it, detail what it is, what it isn't, and why it is or isn't important. In the description of this video, you'll find a link over to the investor newsletter if you want to take a look around, click on some things, subscribe, or whatever. So let's get into this. The Hacienda Hedge, Mexico's oil hedge. What is it, and why is it or isn't it a big deal? Each year around this time of year, I hear of this so-called Mexico oil hedge. I see people reassuring one another that oil prices will go up after the Mexico oil hedge finishes. But what is this Mexico oil hedge, also known as the Hacienda Hedge? And why do they even do it? According to the International Trade Administration, roughly 20% of Mexico's government revenues derive from the oil industry, and everyone with even a cursory understanding of the oil and gas space knows commodity prices can fluctuate wildly with minimal advance notice. It would only make sense to hedge yourself when 20% of your income is dependent on such a volatile resource, and that's exactly what Mexico does. If you're asking yourself what volatility, a picture is worth 1,000 words. Keep in mind that 2 years might seem like a long time to you and I, but in capital-intensive industries with long lead times, it's not. Here's an image saying U.S. oil prices turn negative as demand dries up. April 21st, 2020. Then less than 2 years later, Bloomberg on March 14th, 2022 titles an article, Oil Hedges Go Out of Style as FOMO Grips Drillers Amid $100 Crude. Just imagine trying to plan a budget when a material portion of your income is prone to the vagaries of the market. To make it more relatable, imagine trying to plan for a mortgage payment, but some months you make $10,000 and other months you make $3,000, or adjust that to whatever your living standards are. And yes, with income variance like that, your mortgage lender would also be cautious. And by cautious, I mean charge you a higher interest rate. Well, the same holds true for sovereign countries. Their creditors want smooth, predictable income that they can model to know how much and at what price to lend. And Mexico wants the creditors' money and happy citizens, so they play ball by hedging their oil production. In doing so, they're able to fund their sovereign debt at a lower price. It's really not a horrible idea with all the drama and trauma that occurs in the world. And since oil is a global commodity, an incident somewhere can impact the producers everywhere, for both the good and the bad. Many commodities are feast or famine. They struggle to have moderate and iterative homeostatic consistency. As you can see in this picture, all the fluctuations from below $20 to above $100. Arab oil embargo, Iranian revolution, Iran, Iraq, war begins, Gulf of Mexico, Asian economic crisis, blah, 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 on and on it goes. That's the point. The hedging process is carried out by the Secretaría de Hacienda y Crédito Público. You can now see why the English-speaking countries shorten that to Hacienda Hedge and simply call it the Mexico oil hedge. The hedging process involves Mexico buying options and put spread options. These options take the form of an Asian option as opposed to the American-style option, meaning that the option is based on an average price over a period of time versus the more traditional style that you and I are familiar with, which depends on a specific price on the exercise date. This is all to say that they're not stupid about it and are taking a more sophisticated, calculated, and shrewd approach. The reason it's spoken about so frequently is because it's one of the larger hedges that take place, often after $1 billion or more. Over time, they're smartly become. Man, I need to work on my grammar. Over time, they've smartly become more cloak and dagger about it in a more secretive manner. Why? Because people try to front run them. They've also been casting a wider net of counterparties to secure the hedges for them. They started off with the big US banks, and then they expanded to European international banks. And then they're now expanding even further into doing business with the trading arms of oil conglomerates such as the Royal Dutch Shell. This is smart. It forces the counterparties to squabble with each other for the business and thus compete away costs. A fun rabbit hole to go down is the likes of Trafigura, Glencore, Vitol, etc. If you haven't heard of them, it's not a coincidence. The less attention they get, the better off they are. It's a needed business, but not an appreciated one. I bring this up because Royal Dutch Shell is a registered swap dealer under the Commodity Futures Trading Commission, CFTC. As such, they're subject to capital and collateral requirements, which is the type of things that you want out of a counterparty when putting on a hedge. If you want, you can go to this site. What you'll notice is that there aren't too many registered non-financial firms dealing in swaps. This speaks to how big a player Royal Dutch Shell is in the swap market space. The global swap market is a multi-$100 trillion industry. The only time I've seen those sort of numbers is when looking at the economic miracle of Zimbabwe. You can think of the Hacienda Hedge as self-insurance. They're not pulling up their Schwab account and buying puts. These are tough negotiations happening behind closed doors. Why does this all matter? Simply put, once upon a time, Mexico, in a small window of time, would put on a bunch of hedges via put options. The banks, which were the counterparties to those hedges, would sell put options to Mexico. In order for the banks to hedge their own exposure, because they're essentially long, they would go into the futures market and consequently put pressure on oil prices by buying puts themselves to hedge their long position with the put options that they sold Mexico. All this put buying activity would cause a short-term drawdown in the oil future price. If you or your trading desk knew that this was happening, you could scalp a profit by front-running it. And by scalping a profit, I mean make millions of dollars, because you're playing with tens, hundreds of millions of dollars, if not billions. If enough people or institutions front-run it, then it will cause the premium to go up on the option. This is in part why Mexico has tried to make this more secretive, has gone about conducting business with numerous party members, and has expanded the window of time in which they execute their hedging. Another reason why the Hacienda Hedge mattered was that if they got too aggressive selling into the market, they would drive the price down in the short term. This is another reason why they've spread out the time in which they take to put their hedges on. The more the price drops, the closer their hedge would be to being in the money, and the higher the premium cost would be on the put options that they're trying to buy. This information can be gleaned from such sources as the Freedom of Information Act and access to Mexico's auditing firm. It is my understanding that the Hacienda Hedge is less meaningful than it used to be. It seems mostly a non-starter to me, but I could be ignorant. That does happen after all. Over time, these sort of market abnormalities are learned about by enough participants that they disappear. As I'm writing this, the yearly Thanksgiving oil massacre is occurring. One would think that two will get ironed out in the markets one day, but some things are structural and patternable due to how a system works. OPEC meeting plus lower liquidity due to holiday plus December oil contracts all culminate to create these phenomena. You still might be asking, why Mexico? Mexico is the 11th largest producer. Why aren't we talking about the top 10 producers? Shouldn't their bets and hedges be bigger and larger? Or shouldn't we be talking about the more fragile economies that are even more heavily reliant on oil for fiscal spending than Mexico? The answer is simple enough. Many of the larger producers don't derive near as much government revenue from oil as a percentage of overall income as Mexico does. It's also worth noting that many of the largest producing countries don't have state-owned oil companies. Mexico's is. In regards to the smaller countries, they either don't have the personnel to competently execute on such a hedging bet, they don't have the funds worth risking, or they're afraid of the political backlash that would come from doing it. Some sort of manufactured indignation along the lines of, oh my, so-and-so bought insurance against oil prices instead of building a school with that money, or building a hospital with that money. So let me ask you this. Why would a politician risk giving their political opposition a juicy headline story along those lines? The answer is they wouldn't. So, in conclusion, the IMF does a great job at detailing why Mexico does what they do. There's a link there. Yet again, here's a link to IMF talking about the benefits of Mexico's oil hedging program. And one last time, here's a third link to an IMF article talking about governments hedging oil price risk. Yet again, you can find this article in the description, you can read it, you can scroll down, you can find these links if you're interested in reading about such things. Why so many references to the IMF? Because money and nowadays credit makes the world spin. And what the IMF and the World Bank wants, they get. And either the countries play ball or they don't get the money. Bonus fun fact, both these quote-unquote worldly organizations are headquartered in Washington, D.C., next to all the hardworking, honest, pure, and selfless leaders. That's another conspiratorial rabbit hole you can go down as to why the International Monetary Fund and the World Bank just so happen to be located where they are. So, with that, in conclusion, we are done with this article. If you're new to this channel, this is when I then transition over to my stock market or my stock portfolio review. Do that once a week. So, if you're interested in that, stay tuned. If you're not, then don't. So, here we go. I'm in you can't see it on the screen. I'm in 2.33% cash, so negligible amount. I'm trying to build that back up. I plan on, I think I noted this last week. I'm going to try to remain disciplined, build up my cash position as the portfolio gets larger. You know, like I said, this is all walking through new investors who might be squeamish and such about building a portfolio. It's how to do it, and it's naturally easier to build up cash position as a percentage of your portfolio when you get started, and then it's more difficult as things progress. So, I mean, it would take me a whole year to get to 50% cash, all else being equal. So, that's interesting. So, another interesting thing is SurgePay is now the best. The amount of rotation occurring in my portfolio, this is like, not only is it individual volatility of stocks going up and down, but it's the volatility between names going up and down. So here SurgePay is my best performing stock of the year. I would have never guessed that. And I'm up 44% on it. Uranium Miners is up 43%, so it's 1% behind SurgePay. Like, who would have thought? And then Kinross, and I kind of would have thought this is why I bought it. Third best position, up 31% for the year. You know, they say that you know you bought the right amount of something when when it goes up and you wish you bought more. I kind of do like that saying. I think I've mentioned it once before. And that's where I am with Sprout Physical Uranium Trust. Up 21%. Wish I bought more. But wishing isn't a decision-making process, and what caused me to purchase that amount was, so is what it is. As I mentioned, the oil massacre happened. The Thanksgiving oil massacre happened. Some years are worse than others. It's been a bad couple of weeks for oil. I mean, it could get worse, don't get me wrong. You know, OPEC meeting is coming up at the end of this month. God only knows. You know, how long will OPEC keep cutting to lift the prices for those who aren't cutting, you know? So maybe they do, maybe they don't. Maybe OPEC Plus cooperates, maybe they don't. I don't know. I can't say, oh, you can't see Franco Nevada on the screen either. So I am down 5.42% on that. Seemingly the First Quantum Cobra Panama mine has been put into care and maintenance, or the production's been throttled back. I can't remember which it is. It seems like the protesters are blocking ports and making it difficult for Cobra Panama to be able to fuel their energy sources and export goods and so on and so forth. So that's not looking the best. That could fall some. And I can't, like I said, I haven't added anything. I haven't bought the dip in anything really. Just treading water, and pretty much, honestly, the market's in control. I have no intention really of deploying capital the rest of the year, so we're just going to kind of ride out December, the rest of the month, ride out December. I'm pretty confident that I underperformed. I'm up a little bit, maybe a percentage or two on the month. So any month in the green is, I guess, a good month, but they have to compensate for the months in the red. And historically, and by historically I mean the last 3 quarters, I have one really good month and then 2 not so good months. But the one really good month, I mean, that's how it worked every quarter. I had a banger of a month, 10, 15%, and then the other 2 months I bleed off. So if I'm going to have a banger of a month this quarter, it's going to have to be December, because it was not November. It was not November. So we'll see what happens. So best I can do is research, educate myself, conduct myself appropriately and conducively in relation to my goals. That's what I'm going to do, and whatever happens, happens. And that's really where I'm at with things. So I don't really have anything to say. Didn't add, didn't subtract anything, and things are playing out. Uranium is... I don't like big moves. I've said that. I'll keep saying it. I just like slow and steady. Slow and steady. I like a nice Bernie Madoff situation with anything. It's easier to stomach, and it's more believable, and gives people time to acclimate. Don't like radical moves. I just don't. Above average in neuroticism and everything else. I just, it's like, oh my gosh, like how sustainable is this? I don't like rocket ship straight up charts, which is what the uranium price chart looks like. It's like, oh, like, you know, is this the beginning? Is this the way, you know, to $200 a pound, or is it going to pull back? I mean, who knows? Who knows? I just like slow and steady. Now, if you can tactically trade around this, big moves is the way to do it, because you could have a blow off top, $200, $300, $500, whatever, you know, whatever fanciful number you want to choose, and then you could sell that, because if it was slow and steady over the months and quarters, then what would happen is new production will come online, and you would never get to say that $200 ceiling, that blow off top. But if things move quick enough, you can get a blow off top. But then that presupposes that you can sell. Like, it'd be much nicer for things to kind of float up to $100, and you, like, okay, it's economical to mine uranium, things are coming online, the Oh, I can't think of the location. That one big mine that's coming online that was in care and maintenance. Drawing a complete blank on it, in Africa. And those start coming online, so maybe you top out at 100 and it kind of floats around there and then falls back down as more supply comes online than demand. But demand's increasing and supply's in a horrible position, so who knows? A lot of moving parts. But I'll leave it at that. Thank you for watching, and hope you all had a happy Thanksgiving or happy holidays. So with that, thank you for watching. Oh, and oh my gosh, I almost missed it. I hit 100 subscribers. Whoever is watching this is probably a loyal fan. So thank you. 100, that's really exciting. I mean, it's a step in the right direction. I don't want to be like, oh, I don't want to be that humble person. I also don't want to be that ambitious person. It's 100. It's awesome. Thank you. I really appreciate it. I hit 500 watch hours. Really appreciate that. Thank you. I do it for me, but I do it for you all as well, to hold me accountable, and maybe you watch these videos to hold yourself accountable, or entertainment, or using me as a Jim Cramer of sorts, and contraindicator. I mean, whatever you do, thanks for watching. I appreciate it. Thank you. Till next week.